Welcome, my name is Eric, and this is a repeat, but a shorter version of how to become your own banker. I put this video out a couple days ago, and I had a lot of you comment that they really liked it, but it was a little too long. They wanted to send it to a friend, but they thought the spreadsheets were just too much. So, in this one, when we get to the part where you would normally see a spreadsheet proving everything, this is where I throw it into the black box, everything works, and poof, it comes out the other side perfect, right? I hate it when people do that to me. But I'm going to make this thing shorter. If you want to see the spreadsheet, it's in this longer version, or if you want it with your real numbers, get a hold of me. I made this spreadsheet. I can put in your real numbers and you'll see exactly what you'll be saving when you become your own banker. Look forward to helping you. Thanks. Good evening and welcome to my webinar. My name is Eric Martineau. Tonight what I want to do is I want to go over the concept of becoming your own bank by implementing the private equity banking system. Now what I'm going to follow and give tribute to is a gentleman by the name of R. Nelson Nash. That's his picture right there on the 4th edition of his book called Becoming Your Own Banker. I would suggest everyone read that book. He is considered the father of the infinite banking concept. In other words, how to unshackle yourself from usury and the banks that are charging us crazy amounts of interest. If that sounds interesting, I think you'll like this class, and you definitely would enjoy reading his book. So please do. Here's one of the quotes. Every person needs to practice 2 professions. The first one is the one you're trained in. Simple. The second one is the business of banking. Have you ever thought of that? That you need to have those 2 professions? Well, I think after this class tonight, you will understand why. Another quote from Nelson Nash. The greatest problem in the financial world today. That's a pretty strong statement, right? The greatest problem in the financial world today is that people are thinking about saving or investing money rather than creating a banking system. And I'd venture to guess that nobody's thinking of creating a banking system because we've never thought that was possible. That's just for what rich people do. But I'm going to teach you tonight how, using his ideas, on how you can become your own banker. Okay? So I want to emphasize something up front. Private equity banking, or the infinite banking concept, as you'll hear it called, or becoming your own bank, is a system. Okay? It is a process. It is a way of life. What we are doing with private equity banking is taking upon ourselves the functions of a bank, or being our own banker, as Nelson Nash calls it. So what we are doing is we're becoming the depositor in our own bank because we're the owner of that bank. We're becoming the lender, and when banks lend money, they make money. And so we also become the beneficiary of the profits within our own bank. Now, I want to emphasize this. What private equity banking or infinite banking is not. Private equity banking is not a product. Also, private equity banking is not an investment. Don't confuse the tool with an investment. So insurance is still insurance. Insurance is there to take a risk, in this case life, of you dying and not being able to provide for your family. It's taking that risk and putting it on the shoulders of an insurance company instead of your own, right? So that's still what insurance is. That high cash value insurance allows you certain benefits that allow you to become your own banker is a separate issue. But insurance is still insurance, and in my mind, it is not an investment. So again, to reiterate that, a lot of people will say, well, isn't private equity banking or becoming your own bank or infinite banking concept nothing more than a euphemism for the term for, whole life insurance? No, it is not. Whole life insurance is still whole life insurance, although if it's properly structured, it has certain properties, right? A properly structured, dividend-paying, whole life insurance policy does allow you to invest if you use it that way, right? But it can also be used just for savings, right? So it's just the tool. Don't confuse the tool with the system. The being your own banker that Nelson Nash talks about it's a lifestyle, it's a process, it's a system, but that comes from your mind and how you look at life. It's not the life insurance policy all by itself. I hope that makes sense. Okay, so this banking system is all about the flow of money. And I know you may be thinking, wait a minute, I've never heard that before. Yeah, it's about the flow of money. So let's think about that. You've got a job, you've got a business, and money flows into you, right? But then where does it flow from there? That's the question. So we know that immediately 35% of it's going to taxes, state, local, national taxes. About 35% of what every American earns goes straight to taxes. The next place, 35% of every dollar we make goes to pay the interest for financing companies. And I'm not talking about the cars or the credit cards themselves, the things we buy with the credit cards or the cars that we buy. I'm talking about the finance fees that are going to the banks. 35% of what we do every single month with our money is give it to a finance company. That is the average American. And it doesn't matter if you're a doctor making $400,000 a year or a school teacher making $60,000 a year. The percentages are always there. And it's about 35% per household. Then the next one is our lifestyle. And that's where we spend about 25% of our money. Again, it comes in, it flows out. It comes in, it flows out. This is our gas, our food, etc. And then the average American family really only spends about 3%, but I've bumped it up to 5% just to be nice on savings and investing. So that's our 401ks, whatever. So that money, in theory, is still staying with us, right? So 95% of it comes in and goes out just about as fast as it gets there. And 5% is what we keep. Another quote by Nelson Nash in this book. He says, "The infinite banking concept is about recapturing the interest that one is paying to banks and financial institutions for major items we need, like cars and homes and investments, and redirecting it back to ourselves." If you've never heard that before, let me reread that, because this is probably the most important concept tonight. The infinite banking concept, or private equity banking, or becoming your own banker, however you've heard it spoken about before, the infinite banking concept is about recapturing the interest that one is paying to banks and financial institutions for the major items we need, like cars and homes and investments, and then redirecting it back to ourselves. I mean, think about that for half a second. If all you did is recapture the capital that you spent on cars and homes and investments, and the financing on top of that, and you brought it back into one big pool of money during your life, how big would that pool of money be, and how much better off would you be? Okay, so that's what we're going to talk about. Another quote, and this one's also very important. You finance everything you buy. You either pay interest to someone else, and then here's the part most of us don't think about, or you give up interest you could have earned otherwise. In other words, as we say when we get an MBA, it's the opportunity cost lost. So once cash flows away from you, that's an opportunity cost lost forever. And most of us don't think of it that way. So again, you finance everything you buy. You either pay interest to someone else or you give up interest you could have earned otherwise. And again, his definition of infinite banking is to recapture that interest that we're giving to others. And that's what we're going to discuss tonight. Okay, before we get too far into it though, I want to explain. There are different stages. But before we do that, let me explain again this private equity banking system. Again, it's a system. So the stages are not what you do with the money in your private equity bank. These stages have more to do with what percentage of your total income is flowing in and out and in and out and in and out of your private equity banking pool of money, your private equity bank, your infinite banking system. That's what we're talking about, okay? So the first stage that people get into is what I call the saver stage. And this is like your emergency fund. And it's usually, say, 5 to 15% of your cash flow. That's like the savings that you would put in a bank, except, believe it or not, insurance companies are a much safer place to warehouse your money. But this is the, the first step. So people that want to diversify their liquidity and they want to make sure that they don't have all their money in the banking system or say all of it in stocks, things that are risky, then they might put 15% or less of their money into one of these policies. The next step up, again, in the percentage that you're using, is the capital builder. And this is usually 25 to say maybe 35% of your total cash flow. You're redirecting your cash flow through your bank before you go and do the other things that you normally do with your money. So you're using your policy more. You're financing your car. You're using it as a down payment on property. What you're basically doing is adding a business intent to this policy's use. All right, another quote from Nelson Nash. When you borrow money from your policy, you must behave like an honest banker and pay it back with interest. Now, Nelson Nash tells a story about, or uses an example of, let's say, a retail store where you got a small store and your family members want to take the peas out the back door instead of paying for them at the cash register. Well, I learned this concept many years ago from my best friend, one of my best friends in high school. His name is Steve, and he started working at the Wiener Schnitzel. In fact, I think I got a picture of it. Yep, that's the Wiener Schnitzel in Tucson, Arizona that he started working at when he was a sophomore in high school. And he became the assistant manager and then the manager, and he put himself through college working at the Wiener Schnitzel. I didn't get a hold of Steve until many years later. Came home to visit my parents, thought, hey, I'll go say hi to Steve. So I gave him a call, and he says, yeah, I'm the owner now. I was like, wow, that's cool, Steve. How'd you do that? And he says, well, the old guy trusted me. He wanted to retire, and so I'm making payments to him, and I'm now the manager and the owner. I was like, cool. So I went down, he invited me. It was really an interesting, business understanding of how a franchise works, right? Then he says, well, hey, let me invite you to lunch. I was like, okay. So we walk out the back door, and I'm thinking, well, aren't we just going to eat here? And sure enough, he walks around to the front, and we get in line with these other customers. We were like third in line, and he asked me what I want, so I'm looking at the menu. We get up to the front. He orders what he wants. He waits for me to order what I want. He pulls out some money from his wallet, and he gives this girl, like $5 or $6, and buys me my lunch. And I'm thinking, that's kind of strange. Why didn't we just grab a hot dog out of the back, right? And so I asked him that when we sat down. I said, what was that all about? Why did you have to pay? I mean, it's yours. And he goes, well, that would be stealing. I said, it's not stealing. You own the place. And he goes, yeah, I own the place, but if I don't account for every hot dog, then, I bought 100 at wholesale. I need to sell 100 at retail. And so I have to keep track of my inventory. And so it isn't proper for me to do that. And he said, besides, although, like you said, it's mine anyhow. I mean, I paid for the hot dogs in the first place. The problem is if I do it, my employees are going to think they can do it. And I was like, okay, that makes sense. So that is what Nelson Nash means by you have to be an honest banker. Because when you borrow from these policies, when you put money, you've got money sitting in a mutual company, a mutual insurance company, in your cash value, that's earning about 5%. And then when you want to borrow money from your policy, they take it out of their general fund. Now, these companies have been around 125, 175 years, so they have a big pool of money that is their profits over all these years. So they don't take the money out of your cash value. They actually take it out of the pool of money that's been their profits over the last 125 years. And they're going to loan it to you at a profit because they're a business. And by the way, at a mutual insurance company, you're a co-owner, so you want them to make a profit. So they're going to charge you, they're going to pay you 5% for the money you've deposited with them, but they're going to charge you maybe, let's say 6%. Now, don't run out and say that Eric's, telling me exactly what these guys are doing. Every company's different. Okay. I've been in this for a decade, but about a 1% delta is the difference. So whether it was 4 and 5 or 5 and 6 or 6 and 7 as rates go up and down in the marketplace, doesn't matter. The difference between what they're paying you and what you can borrow is averaging about 1%. Could it change? Yeah, it could. But for today's example, please understand I'm trying to do that. And another thing I'm going to do is I'm going to merge those two. So we've got a +5 and a -6. That means we're borrowing at a -1. All right. So yes, if you want to be a purist about it, I'm supposed to say that you're earning 5 and that you're paying 6, etc. But I'm going to try to consolidate that and just say 1. So understand when I say that you're able to borrow money at 1, that really isn't the case. It's 5 that you're getting paid and 6 that you're paying. But when you counterbalance those two, your cash value is paying you 5 and you're borrowing at 6. Okay, so the banking system is about the flow of money. And the part where we're going to introduce the bank is that part in the middle. Remember what Nelson Nash stated, that infinite banking concept is about redirecting what we're currently spending on banks and financial institutions and bringing it back. So those that we just mentioned, they're still going to come in and go right back out. But the financing side, we're going to start using our bank and we're going to put it in the middle of the process. That's all we're going to do. We're just going to set it in the middle of the process, okay? So now we're making 5% when it comes into the bank as the depositor, right? But we're also a bank owner, which means as an owner, we can lend money. And now we're lending money above that 6% because the bank's charging us that. So now we're charging the fair market value to the people that we're lending our money to. Now, if, as he said, we're our own private banker, right? Be your own banker. That's what it says right up there. So if we're lending that money to ourselves, that's why he says we have to be an honest banker, because the net effect of borrowing, as I just said, was 1. But what did we just state was the cost of getting credit cards or a car or a student loan or a HELOC or whatever, right? The credit cards are anywhere between, say, 8% and 28%. And the cars are running about 7.5 right now. And HELOCs are at about 6.5 and student loans are 6.5. So what he's saying is that you need, even if you're the only person you're lending to is yourself, because you can lend it to your kids or you can be a hard money lender with this stuff. You can do whatever you want with that money. The bank, the insurance company doesn't care. But let's just assume that your very first client is you yourself. And that's why he's saying we need to be an honest banker with ourselves. And so if that credit card was costing you 23, you need to continue paying 23, even though it's only costing you 1. So let's walk through those numbers and see how this actually plays out. Why? Because that fourth function that we're taking upon ourselves as a banker is the beneficiary of the interest that we're charging. And so we're going to be paying ourselves back what we would have been paying to financial organizations. So let's walk through this. The credit cards. Now, I've got a fictitious gal that's in college. She's just getting out. She's, say, 21 years old. She's $9,000 in credit card debts because they gave her those free credit cards as soon as she walked out of high school. Don't ask me what makes you credit worthy walking out of high school and stepping onto a college campus. But the financial world thinks that they need to indebt us all, and so there we go. So let's say she's got $9,000 in credit card debt, and the average that she's paying on those cards right now is 23%. That means that her monthly payment right now, if she wanted to be able to pay this off in about 5 years, would be $250. So of that $250, 173 of it is going just to pay interest, which means, if you haven't heard this term before, the volume of interest that this young gal is paying is 70%. Now, she's going to be able to pay this off in about 5.2 years. Now, think about this one. I know we don't like to think of it. She's bought $9,000 worth of goods, right? But by the time she pays this off in 5.2 years, she will have paid $6,500 in interest. That means she's got $15,500 of goods that could have cost her $9,000, right? If she'd say pay just cash, and we're going to talk about that tonight too. So when she funnels this stuff through her banking program, she's going to end up paying this back a lot faster. So let's walk through those numbers. Again, $9,000 is the total credit card debt. Maybe there was 4 of them. Now the net effect is that it's only costing her 1%. So what we're going to have her do is not reduce the payment, which she could. We're going to have her keep paying $250. But look what's happened to the total interest portion of her payment. It's only $8. That's 3%, folks. Volume of interest is only 3%. And what was she paying just a minute ago? Nearly 70, right? And she's going to be able to pay this off instead of in 5 years, in 3 years. Now, she still has to be an honest banker. So we've got the $9,000, which is the original debt that she needs to pay off. And then she's got the $6,505, which is the fair market value of interest at 23%. So she needs to continue paying back $15,505. That's the flow through her bank, so that she recaptures that interest instead of having it go somewhere else. So what's the process for doing that? Well, we had said that if she was paying this over, the normal way to the credit card companies, it would have taken her 5.2 years. But if she's going to be an honest banker, she needs to keep paying that $250 for another 25 months, 25.8 months, right? So she's got 2.15 years free times 12 months. That's 25.8 months. She needs to keep paying $250 a month. And what is that called? Premiums. She's going to pay the insurance company an extra $250 in premiums for the next 2 years, so that she ends up shoving another $6,450 into her private equity banking account. And that's what makes her an honest banker. Does that make sense? So again, she's just recaptured the interest, the 22% that she would have. That's why there's a difference here between $6,505 and $6,450. Why? Because the insurance company made the difference between $450 and $505. So they made what, $55 there, and she made $6,450. So that's why this is cool. All right, let's go on to the next one. So let's say that she now wants to get a car. She's out of college. She buys a nice car, $49,000 car, 7%. Okay, so she's still going to be an honest banker. Let's walk through these numbers one more time. $49,624 for the original cost of the car. $13,117 is the fair market value at 7.5% of interest that she should have been paying, which is fair market, right? So that's $62,741 that are going to flow back into her private equity bank. Here's the numbers. This is what's happening. Remember, so she was going to make these payments for 6.5 years, but now it's only going to take 5.24. So that leaves her an extra 1.5 years multiplied by 12 months. That's 15.1 months of extra payments at $811. So that comes to $12,262 in extra premium payments that she's going to make to call herself an honest banker. All right, 6.5. So she got a really good education. She spent $125,000 on it. They're now charging her 6.5% for student loans. Her monthly payment is $1,116. Okay, the portion that's going toward interest, $677. So that means her volume of interest, again, is 60.7%. Again, most of us think APR. Oh, I've got an APR of 6.5. No, you're really paying a volume of interest of over 60%. Okay, this is going to take her 14 years to pay off her college education, 14.4 to be exact. after she's through paying it back, that $125, she's added another $67,800 to her interest that she was paying. Think about that. That's $67,000 that she's going to push through her bank and back in, so that pool of money is still there, including the interest moving forward in her life. Okay, so she still needs to be an honest banker. So we're going to recapture the $125,000 from the original student loan. We're going to recapture the financing that we would have spent to the federal government lending institutions of $64,293. Again, the fair market value was 6.5. So she's going to bring back through her bank $189,000. Isn't that cool? And she's going to be able to do it in 9 years. So it would have been 14.4, and she's going to make it 9.8. So that's 4.6 years extra. Multiply that by 12 months. That's 55 months that she's going to be paying back to herself a total of $1,116. So at the end of the day, she will have recuperated $61,603 by paying extra premiums into her bank, making her an honest banker. This is what it looks like over 9 years. Recaptured $183,000 in capital, recaptured $79,000 in interest. Her private equity bank has now $262,000 at 5% interest the rest of her life. So we got a problem here. We no longer have 35% of our money going toward interest and financing. So what's she going to do? She now has 65% of her money available that she still kept up the habit of paying that same amount into her policies. Now, you might be thinking, but wait a minute, Eric, didn't you just get through telling me that an insurance company won't do more than 15% of your income? Or if you get a properly structured policy with somebody that knows how to do this, maybe 25 to 35%? How on earth then is she going to get 65% into this and into one policy, right? And this is where we bring in the third stage of private equity banking system. And this is where we will end up needing multiple policies. On this side of the line, we need multiple policies. And the reason I'm saying this is because if you are, say, 40 years and younger, and your parents are still alive and they're 72 or 73 and younger and in good health, do what that guy said to me. Buy this policy on your parents. Yes, the cost of insurance is going to be more than it would be on you at your age, but they're going to pass away before you do, right? Now, again, I was thinking, well, my mom isn't going to pass away for 50 years. And as it turned out, she ended up passing away a lot sooner. She grew up in an area of Nevada where the United States tested nuclear weapons, and she died as a downwinder. Because of that, and she ended up going, in her early 70s. So, she left us 25, 30 years sooner than anybody would have ever predicted that she would pass away. But the point is, again, if you're using this as a banking system, it doesn't matter whose body that you use. Well, it does. It has to be somebody that you have an insurable interest on. So it needs to be a family member, a business partner, or something like that. But if your parents are healthy and under 73, 72, that's where I would suggest you get one of your very first policies, because the odds of them passing away before you do, leaving you a windfall of tax-free money that you can then shove into your banking system, that's going to kickstart things a lot faster than if you're 30 and you don't pass away until you're 85, just a thought. But again, on this side of the entrepreneurial area, you're going to want to put in, say, 50 to 75% of your money. And notice here I put here, use the policy often as a tool instead of cash. Now, those that have grown up on the Dave Ramsey mindset would say, well, why would I ever borrow money for myself? So let's walk through some of these numbers, and we'll see. Let's say that our 30-year-old is now married, and she's married a guy that grew up listening to David Ramsey, and she thinks that, or he thinks that she should only spend cash, and she's got it. So why don't they buy their house with cash? Well, here's the idea: $350,000 they pay cash, or they borrow that money through their private equity banking account, right? And notice here that for the first time tonight, I've thrown out some new numbers. I've put 3% and 6%. In other words, the insurance company is paying you 3% on your deposit, and they're charging you 6%, right? And so the question I have then is, if my cash value is 3%, is growing at 3%, that's what they're paying me for my deposits, and they're charging me 6%, does it make sense to borrow? And that's what her husband's asking her, and that's what I'm asking you. Again, if my cash value is growing at 3%, does it make sense to borrow at 6%? And if you agree with her husband, and I agreed with you, we'd both be wrong. because it's still going to be better to do it this way. Now, why did I choose the number 3% when I told you earlier that you get paid about 5%? Because these insurance policies come with a guaranteed section and a non-guaranteed section. That's just that. The guaranteed section is what they've put in a contract that they guarantee you they're going to pay you. And let's say it's right at 3%. And then they're going to pay dividends every year. They don't have to, but they have every year for 125 years or 175, depending on how long that company that you're with has been around, right? But in saying that we're at 3%, what I'm saying is this is something that has never happened before with a mutual company, and it would be the first time. And if this is the case, I'm also saying that it's happened 15 times in a row. So very, very rare that this would happen. But again, to make my point, your money's growing at 3%. It's making they're charging you 6%. Does it make sense to borrow? But finally, we get down to the last year. $198,000 is what you've earned in cash value or in interest, and you've paid $181,000. So the net effect is you've positive cash flowed $16,971. And I can hear her husband going, come on, honey. 15 years to make $16,900 on a $350,000 loan. Let's just pay cash. So you might still argue that, even so, right? But I've got a question. How much money did his $350 make in year 1, 2, 3, 4, all the way to 14? Nothing. What's it going to make for him next year? Nothing. But what has hers done? Right? So let's now move this to 5% as though it was something closer to what would be really expected. $17,000 is what you make in interest in year 1, and you pay $20,000. And then by year 4, you've made $77,000 in interest, and you've paid $76,000. So there's your break-even point. Instead of at 15 years when it was 3% versus 6%, now you've broken even in year 4. Again, this isn't a get-rich-quick. This is not a get-rich-quick scheme. Okay. Here's another difference. In year 5, $449,000 in cash value, okay, versus $266,000 is the principal that we still owe. See that? So the reason that the math works on this is that this side is going to continue to grow, whereas this one goes down. So we're paying 6% on this column. We're earning 5% on this column. As this one gets bigger, it overwhelms this one, and this one continues to get smaller. $739,000 is there in the cash value. We've earned $389,000 in interest. We now owe nothing here, and we've paid $181,000 in interest. So the difference between those two numbers is $208,000 positive. So if you want to think about it this way, this home, instead of costing them $350,000, cost them $141,000. Now, I already asked the question, how much of this $350,000 earned them a penny during the last 15 years? And the answer is no. But here's the real question. Do you think their lives are going to end now that they're 45 years old and have $739,000 sitting in their cash value and nothing in debt? Think about this. And this is, I hoped you saw that this is realistic. This is a young gal who at age 21 had $9,000 in credit cards, graduates, buys a nice car, pays off her student loans, and at age 30 has $350,000 sitting in the bank. She and her husband buy this home, and by the time they're 45, it's paid off, and they have $739,000 sitting in the bank. Now what? Does life end there? Again, how much money had that $350,000 made during the last 15 years? And more importantly, they're only 45. How much is it going to make in the next 15 years, right? So if they make it to 50, $949,000 in cash value. If they make it to 55, $1.2 million. They make it to 60. I'm 60. That's $1.5 million. And if they make it to 65, now what? They've got $2 million sitting there. And what does she and her husband say? We're out of the rat race. We're done. We're going to borrow $100,000 against that $2 million every single year until we die. And the cash value is still going to grow every year. And we'll still leave a death benefit to our family. So paying cash is not the right answer either. Now we get into the last stage, which is generational wealth. Like I said, on this side of the line, we need multiple policies. It is better to use borrowing than it is cash value. In column 3, you're going to be using 50 to 75%. And now in column 4, we step into a world where we have, and you'll notice I put the words down here, strategic loan balances of between 20 and 35%. What do you mean? Well, remember that first arrow we saw that was paying taxes at 35%? Well, now what you're doing is you're pushing your taxes through this first. And if you think about it, my dad was a CPA. I'm not allowed to give CPA advice because I'm not a CPA, but my dad did work for the IRS, and what he taught me was that he said to me one time, you pay your taxes the last day of April, April 15th or whenever that date is. And then, oh, he's got extensions. But he said, asked me the question, what happens in May? If you pay your taxes in May and they're not due until next April, you've just given the government a loan. And so I would shove my money into a savings account because I didn't have these policies before my dad passed. But now that I understand it, I shove them into the policies and I earn interest on it. And at the end of the year, I pull it out as a loan that I never plan on replenishing because all that cash value is now earning it. So you're going to have your charitable giving, your taxes, things like that as what we call a strategic loan balance, and you're just going to push it all through there. So at this point, you got 100% of your cash flow flowing through. So let me tell you about Diane and I so you understand where I'm coming from. I answered an ad that said, if I could show you how to pay off all of your debts within 6 to 9 years without earning any more income or paying any more out, would you be interested? And I said, yeah. So I called the guy. He created me a get out of debt policy, he called it. And it was going to be about $470 a month in premium. And at the time I was making about $15,000 a month. So if you look at that, that's about 3% of my income. And he structured it for me. He asked me what I did for a living, obviously. And I told him I sold property and casualty insurance for a very large insurance company that starts with an A. And he went, oh, do you have a life license? And I said, yes, but I'm not allowed to use it. And he said, well, but you have a license. And I said, yeah. And he goes, okay, well, then you can come and learn about this because you have to be a licensed life agent to come and get training on this. And I said, oh, okay, I'll go. So I took a couple of days off from work and I flew out to Florida for some training. And I was there the first morning and I had just listened for, I don't know how I remember, we started at 8 o'clock in the morning and we probably broke at 1 or 2 for lunch. So maybe 4 hours. But the person that had presented talked about the numbers and all of a sudden it clicked. And so when I went into the dining area, we were at a hotel, and I went into the dining area and I looked for the guy that had invited me to come. Again, he was one of the presenters, so he wasn't sitting next to me during the presentation. And so I walked up to him and I said, hey, Mark, I don't want a policy for $470 a month anymore. And he was like, what? I said, yeah, I want a policy that I can put $9,000 a month into. And he started laughing. Now, he's a New Yorker, and he has a New York accent, but he threw in this, cowboy accent. He said, hold down there, cowboy. Slow down. We got to take this thing one step at a time. Well, what he wasn't explaining to me was that literally there is no insurance company that's going to give you 70% of your income in death benefit or payments because it's just be too much. So what I ended up with was a policy probably in this area here to pay off debts, but to do other things with. And my policy, I can throw $5,000 a month into it. And I've been doing that now for many years and have over $300,000 in cash value, which again, at the time came to about 34% of my income. So where are Diane and I today? Well, we did get to this point. All the houses are paid off. And so we've got no debts. And so we do want to shove more money through it. And so we needed another policy. But because of health issues, we were strapped with just my policy. And so we ended up getting a policy on one of our sons. And between those two, we can get about 100% of our cash flow on an annual basis through just 2 of our 8 or so policies. We got some policies on the grandkids and the son-in-law, etc. So have we become what the Rockefellers did and have an entire banking system within our extended family? No, we have not. So to be honest with you, Diane and I bounce in and out of this area here, but we do have multiple policies. We can fill them to the brim every single year, and we've been doing it. We've used it to finance 2 homes now and 2 vehicles. So 2 vehicles and 2 homes since we found this program about 10 years ago. We've been able to finance through these programs. So it's something that really works. And again, it's crafted to you. Again, you start here. You really, the insurance companies aren't going to let you go beyond level 2 or stage 2 anyhow. So if this seems to make any sense, if it seems too good to be true or whatever may be running through your head, get a hold of me. Let's walk through this and I'll help you out. But again, I want to thank Nelson Nash for this book. If you want a copy of it, give me a call. I'll get you a copy. I'll send it to you. It's probably one of the best books that I've ever read as far as changing my financial view on the world. And believe me, like I said, I didn't get taught this in my MBA, but I heard about it. I just didn't understand what it was. Again, it wasn't the private equity banking. It wasn't infinite banking concept. It was just the idea of owning policies on your parents. That would have, never come through my mind ever. But anyhow, love to help all of you. Again, there's my information. Give me a holler. If you like it, if you've got questions, ask questions, put questions in the YouTube. If you're watching this, ask questions and love to answer them for you. Thank you. And share it with a friend. Send this off to somebody that needs it. Thank you.